Investors are buying real estate. This is the most common mistake I'm seeing them make. They're only focusing on one type of appreciation when there are two other types of appreciation that are available. In this video, we're going to break down all three types of appreciation, especially and related to the BC real estate market. And so you can benefit and come out further ahead and help leverage your money where numbers in British Columbia, let's be honest, if you're an investor right now, the numbers aren't really cash flowing. I mean, you can look hard and you can find definitely some deals out there to be that will cash flow, but cash flow isn't the play in British Columbia. It is appreciation. So we're going to focus on three different types of appreciation factors and how it can apply to you and implement it into your business and your investments so you can grow, scale, and give more to your family. And if you're new to the channel, my name is Mark Coons here with Selling Kelowna Real Estate Group, where we're highlighting videos every week of buying, selling, investing in real estate market, and also what it's like living in Kelowna. So stay tuned to the channel, make sure you like, subscribe to the channel, and if you are interested in investing or you're interested in the real estate market, please reach out, give me a call, email me, whatever you need to do. I'd love to help you out. And in the link below, there'll be a link to a weekly email that'll give you market specific information every week into your inbox regarding Kelowna. So that'll keep you on top of the market there so you're making educated decisions of whether you're buying, selling, investing. If anything more I can do for you, pick up that phone and give me a call. Most people are only focusing on the first type, and that's the market appreciation. But there's two other types of appreciation that are not really been focused on. When you're focusing on forced appreciation and you're also instant appreciation, those are two different types of appreciation factors that you can implement into your real estate investments so you can grow. And if you're just a first-time investor, or if you're just looking at buying homes in the first time, well, you're going to be in the right place, because you understanding three different types of appreciation is going to give you an opportunity to be able to get into the market and even being able to buy a property. You don't have to be an investor. You could be living in the property, but you're going to gain equity at the end of the day, which is going to save you time, money, and freedom and put more in your pocket down the road. To start it all out, we're just going to focus on appreciation, and the definition of the appreciation is the increase in value over a certain period of time. In reals, it could be 1 year, it can be 3 years, it can be 5 years, 10 years, however long you want to look, but you want to look at how has the value changed over an X period of time. There are certain situations where you might go through a depreciation phase, which if you bought in 2022, you're probably at that depreciation phase where your property value is actually lower than what you bought it at. And so it's not always to say that your appreciation and your value is going to go up over time, because it can definitely go down. But over time, your property values will double in value every 20 years. If you look at the stats here, I'm going to throw up some charts here, and you're going to see where in Kelowna that property values have doubled in value over 10, 20 year period time frame. So when you look at appreciation, we're going to look over the longer time period and just see how the growth has happened. And this is where you're going to leverage if you're an investor, or if you're a first time home buyer and you're just trying to get some more wealth into your family and be that one to change the family's trajectory. This is how a lot of investors will do, and they focus on using other people's money and appreciation. So understanding the first part of appreciation will help you leverage the other one. And the first appreciation that I'll get into here is the market appreciation. And this is what I was referring to, that people, will expect it to see over a 5 to 10 year time period. And you can expect from the market and the market dynamics where you're going to see values change over the 5 to 10 year period. That is the basic of market appreciation. And that's where a lot of people will focus their time. The trouble with that appreciation is it is giving it time period, and you have to have the patience to be able to withstand it. And so there's two other opportunities right now for appreciation that you can leverage. It does take a little bit more time, but you will get the benefits out of it. Market appreciation is really out of your control. You just have to let time do its thing. It's hands off. The benefit of that market appreciation is hands off. You don't have to do anything on it. But if you're a little bit more hands on, this is going to be the two different types of appreciation that you can do to utilize, and you'll get a benefit a lot sooner. The second type of appreciation is instant appreciation. How do you do that? Get instant appreciation. Everybody would love to get instant appreciation in the marketplace. And that is really buying a property that is undervalued. So whether it's coming from a tax sale, a foreclosure, You name it. There's multiple different strategies in getting homes off market that are going to come with an instant appreciation. These aren't going to be the homes that have been on the market most likely that for 6 months or so. These are some of the homes that are just hitting the market and it's a good price property, and there's instant appreciation you can get from buying that because you're buying it under market value. You could go and resell it today for a profit, and that's where we're going to consider for instant appreciation. These deals are few and far between, and you have to really it's like finding a needle in a haystack, and you have to always be on it and finding and associating these deals that are coming through. This is how wholesalers make their business, where they're finding off-market deals and they're wholesaling, tying it up under contract for below market value, and then they're going to assign it to somebody before completion for a higher price point, and that's how wholesalers build their whole business. So if you're telling me there isn't a market for this, you're wrong, because there is. People build their whole businesses on it. And the third and final kind of appreciation, and this is where you can get a lot more hands-on, this is the forced appreciation factor. And this is where you're going to see fixer and flippers and people that buy homes, rehab them, and then sell them on the marketplace. But you can also build it into your portfolio and hold these properties. So this buying and getting properties, you're going to really want to focus on adding value to the property. And oftentimes you're going to want to find properties that have good bones on them, and they're in a good location where you can get out of it even if the market does turn, or maybe there's underlying land value which you can help utilize as far as finding that ideal clientele. The forced appreciation side of things is a little bit more hands-on and capital intensive, because you do oftentimes have to put a lot of time, sweat, and equity into this appreciation, but it does return on it. The keys to finding these ones are finding those homes where, grandma and grandpa are still living in the home and they haven't touched that house in 40 years. And even though it's been well maintained and been well taken care of, there is a lot of depreciation that has happened to the house because it hasn't been properly maintained based on today's standards, based on today's modern standards. There is still wallpaper on the wall, pink carpet on the ground. So there is a lot of different opportunities in the marketplace to find forced appreciation. And this one is one of the toughest ones to really go ahead with. You can find a simple one where it's mom and pop, grandma and grandpa that have this home and it just needs a little bit of lipstick, and you can just redo the kitchen and you just redo the flooring, which are pretty simple at the end of the day renovations to do, versus needing to take out walls and tearing up basements and stuff like that, and save some of those other ones for your third or fourth type of forced appreciation build. The more you can understand those three types of appreciation can help you grow and scale your investment portfolio, and really being able to utilize other people's money. Because what happens when you grow your equity in the properties is you can be able to pull that money out. Banks will often lend 75 to 60% of the property's value. And so if you increase a property's value $100,000 from doing these renovations to the property, you can still hold it. And the bank will now lend you more money, another $60,000 on that property, and you can use that money to be able to put down as a down payment for the next property, or you can keep it or go on a vacation, whatever you choose to do with it. There's opportunities in real estate, and that's one of the appreciation factors. Don't necessarily need to let the market do its thing. You can be hands-on and get things done and get that forced appreciation. There's risks and rewards with each different type, and you want to make sure you're making educated decisions. So if you do have questions on it and do want to know how it impacts you and your business, reach out, give me a call, pick up that phone, whatever you need to do. I have your back here, and I'd love to help you and see how we can help mitigate some of these issues.